Listen to me. December is not just the month of holiday parties and buying gifts for the grandkids. If you are retired, or standing right on the doorstep of retirement, December is the most critical month of your entire financial year. Why? Because when the clock strikes midnight on December 31st, the door slams shut on some of the biggest tax-saving opportunities you will ever have. Once January 1st arrives, you cannot go back and fix these mistakes. The money you lose to avoidable taxes is money you will never see again, and you worked way too hard for way too many years to hand your hard-earned savings over to Uncle Sam just because you missed a calendar deadline. So sit down, pay attention, and let us go through the 10 vital year-end tax moves you must make right now before December ends. Move number 1 is taking your required minimum distributions, or RMDs, if you are age 73 or older. If you have money sitting in traditional IRAs, 401(k)s, or other pre-tax retirement accounts, the government forces you to take out a specific amount every single year. If you forget or take out even $1 less than required by December 31st, the IRS imposes a crushing penalty of up to 25% on the amount you failed to withdraw. Do not leave this to the last week of December when financial institutions are backed up. Calculate your exact required amount today and get those withdrawals processed immediately. Move number 2 is leveraging a qualified charitable distribution, also known as a QCD. If you are age 70 and a half or older, this is one of the greatest tax gifts available to you. You can transfer money directly from your traditional IRA to a qualified charity up to your annual limit, and that money comes out completely tax-free. Even better, if you are age 73 or older, that charitable distribution counts toward your required minimum distribution. If you withdraw the money into your checking account first and then write a check to the charity, you ruin the entire tax benefit. Do it directly, save on taxes, and support a cause you love. Move number 3 is evaluating a strategic Roth conversion before December 31st. Converting money from a traditional IRA to a Roth IRA means paying income tax on that money today, but every single dollar inside that Roth grows tax-free and comes out tax-free for the rest of your life. Plus, Roth IRAs do not have RMDs during your lifetime. If you had a year where your income was lower than usual, maybe you just retired or took fewer distributions, you can convert just enough money to fill up your current lower tax bracket without pushing yourself into a higher one. But remember, the conversion must be completed by midnight on December 31st to count for this tax year. Move number 4 is tax loss harvesting in your taxable brokerage accounts. Look at your individual investments, stocks, or mutual funds outside of your retirement accounts. If you sold assets earlier this year for a profit, or if you have positions that are sitting at a loss, selling those losing investments before year-end allows you to offset those capital gains dollar for dollar. If your losses exceed your gains, you can use up to $3,000 of excess losses to reduce your ordinary income and carry forward whatever is left over into future years. Just watch out for the wash sale rule. Do not buy that same security back within 30 days before or after the sale, or the IRS will disallow your tax loss. Move number 5 is maximizing your workplace retirement contributions if you are still working or retiring at year-end. Contributions to your employer 401(k) or 403(b) must come directly out of your paycheck before December 31st. If you are age 50 or older, make sure you take advantage of the catch-up contributions. If you get a year-end bonus, consider directing a chunk of it into your pre-tax workplace account to instantly knock down your taxable income for the year. Move number 6 is spending down your flexible spending account, or FSA, balance. Unlike health savings accounts, FSAs are generally use it or lose it accounts. If you have money sitting in an FSA, check your plan's specific rules today. Schedule those dental checkups, order those prescription glasses, or stock up on eligible medical supplies right now. Move number 7 is optimizing your health savings account, or HSA. If you are enrolled in a high-deductible health plan and have not hit your contribution limit, top it off. HSAs offer the ultimate triple tax advantage: pre-tax contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. If you make those HSA contributions through payroll deductions before your final December paycheck, you also save on FICA taxes, which you cannot get back if you make direct contributions later. Move number 8 is capital gains bracket management. If your taxable income in retirement puts you in the 0% long-term capital gains tax bracket, you have a golden opportunity to harvest capital gains tax-free. You can sell appreciated stock held in a taxable account, pay zero federal capital gains tax, and immediately repurchase the shares to step up your cost basis. That means lower taxes for you or your heirs in the future. Move number 9 is strategic charitable gifting and bunching deductions. If you itemize deductions or are close to the standard deduction threshold, consider bunching 2 years of charitable giving into December using a donor-advised fund. You get a massive tax deduction in the current year, and you can grant out the money to charities whenever you choose over time. Additionally, donating appreciated stock directly to charity avoids capital gains tax entirely while giving you a full fair market value deduction. Move number 10 is checking your Medicare IRMAA thresholds and state tax obligations. Your Medicare Part B and Part D premiums are determined by your income from 2 years prior. Crossing an IRMAA income bracket threshold by even one single dollar can trigger thousands of dollars in higher Medicare premiums 2 years down the road. Review your total income before December 31st, manage your final distributions carefully, and make any final state estimated tax payments needed to avoid late penalties. Your financial peace of mind in retirement is entirely in your hands. Take control, make these 10 moves today, protect your money, and enter the new year knowing you kept every dollar you deserve.